Hey there, and welcome. So, have you ever just, looked at the stock market and thought, how does this thing really work? It can feel super complex, maybe even a little intimidating, right? But stick with me, because by the end of this, you're going to see it's way more straightforward than you think. Let's dive in. It's kind of wild to think about, but this calm digital world of trading we have today, it used to be absolute mayhem. I mean, picture it. Trading floors jammed with people, everyone shouting, waving their hands, just a whirlwind of paper and noise. And now, it's silent. It's instantaneous. It all happens with a click on the phone in your pocket. The change is mind-blowing, but what's even crazier is what actually happens after you make that click.
Yep, that one simple tap sets off this whole incredible, invisible chain reaction. So, what is this behind-the-scenes machinery that makes it all happen? Come on, let's pull back the curtain and break it all down.
All right, to really get a grip on this, we're going to use a super simple analogy, one that just makes everything click into place. So for a second, I want you to completely forget about stocks and think about vegetables. Yeah, I know it sounds a little weird, but trust me on this one. It's going to make perfect sense.
Just picture this. You're strolling through your local vegetable market on a Sunday morning. You see the sellers with all their fresh produce laid out, and you've got customers milling about looking for the best stuff to buy. That scene right there, that familiar, everyday experience is the perfect way to think about how the stock market actually works.
And check this out. This is how perfectly it all maps out. The people selling the vegetables, those are the companies. The actual vegetables, the tomatoes, the onions, whatever, those are the shares. And the customers, like you and me, trying to get the best deals, well, that's us, the investors. See? Every single piece of that veggie market has a direct parallel in the world of stocks.
So here's the absolute key takeaway. A share isn't just some random number flashing on your screen. No way. It's a real, actual piece of ownership. When you buy a share, you are literally buying a tiny slice of that entire company. You're part owner.
Let me put it this way. Imagine a company has exactly 100 shares in total. If you go out and buy just one of them, boom, you now own 1% of that whole company. It's really that straightforward. You are an owner.
Okay, so we've got our sellers, the companies, and we've got our vegetables, the shares. But where's the actual marketplace? Where does all this happen? Let's switch from our analogy now and talk about the real deal marketplaces right here in India.
So in India, pretty much all the action happens in two main places. These are the official organized markets called stock exchanges. You've got the BSE, which is the Bombay Stock Exchange, and the NSE, the National Stock Exchange. These are the big ones.
So how can you tell if the market as a whole is up or down on any given day? I mean, with thousands of stocks, how do you track that? Well, think of it like this. These exchanges have these massive scoreboards called indices, and their whole job is to give us a quick snapshot of how things are going overall.
I'm sure you've heard these names a million times, Sensex and Nifty, right? Well, the Sensex keeps an eye on the top 30 companies listed on the BSE, and the Nifty 50, that tracks the top 50 companies on the NSE. So whenever you hear on the news, the market was up today, this is what they're talking about. These indices are basically the heartbeat of the Indian economy.
But here's something really important to understand. Not all companies in the index are created equal. The indices are weighted. So what does that mean? It means the huge companies, the real giants like Reliance and HDFC Bank, have way more pull. A small move in Reliance's stock price can shift the entire Nifty 50 index way more than a massive jump in one of the smaller companies. Basically, size matters a lot.
Okay, so we know where shares get traded. But the million-dollar question is, why do their prices go up and down? What's driving that? Well, it all boils down to the most basic rule in all of economics: supply and demand. Let's hop back to our vegetable market for a second. Think about tomatoes. Let's say there's a drought, and it's a really bad season for them. So they're super scarce, but everyone wants to make a nice pasta sauce for dinner. What do you think happens to the price of those few tomatoes?
It's the classic textbook situation, right? You've got tons of demand, everybody wants one, but very little supply, because there just aren't many around. And that creates this real pressure in the market.
And what happens next is totally predictable. The price goes through the roof. Well, guess what? It's the exact same thing with stocks. If a company is doing great, making headlines, and tons of investors are trying to buy in, but not many people are selling, the share price is going to go up. Simple as that.
Now, all this price movement leads to one of two things for you, the investor. If you end up selling a share for more money than you paid for it, that profit has a name.
it's called a capital gain. And if you sell it for less than you paid, that's a capital loss. That's the whole game, right there.
So, we've talked about the why of price changes. Now let's get into the nitty-gritty how. The second you tap that buy button, that little share of yours embarks on this amazing, lightning-fast journey. We could even call it the hero's journey of a single stock trade.
Back in the day, believe it or not, you used to get an actual physical paper certificate for your shares. It was slow, it was clunky, and honestly pretty risky. What if you lost it or got damaged? Thankfully now, shares are all dematerialized. That's just a fancy word meaning they're purely digital records stored safe and sound in a special account called a DMAT account.
Now, this digital trip has 4 main characters, and they all have to work together perfectly. First, you've got the depository. That's like the giant, super secure digital vault where every single share lives. Then you have your broker. They're your personal key to that vault. Next up is the stock exchange, which plays matchmaker, finding a seller for every buyer out there. And last but not least, the clearinghouse. Think of them as the umpire, making sure the money and the shares go exactly where they're supposed to. So, let's follow the path of a single trade, step by step. It all starts with you. You place a buy order with your broker. That's step 1. Almost instantly, your order zips over to the stock exchange, step 2. The exchange, our matchmaker, finds someone out there who wants to sell what you want to buy in like a split second. That's step 3. Then, the clearinghouse jumps in to confirm everything and settle the deal. Step 4. And finally, the grand finale, the share is digitally moved from the seller's DMAT account straight into yours. Step 5. And this whole dance happens behind the scenes without you lifting another finger.
And you want to know the best part? This entire incredibly complex process is completely automatic. Your only job in this whole thing is to decide what to buy and tap the button. The system takes care of absolutely everything else, and it's all done and dusted in just 24 hours. It's a truly amazing piece of technology, and it's all working silently for you.
So, there you have it. The mechanics of the market are this incredible feat of modern tech, all built for speed and to give people like you and me access. But that leads us to the biggest question, doesn't it? We now know how the market works, but the real game is figuring out what makes a share worth owning in the first place. Why choose one company over another? And that, well, that's the big question we'll have to tackle next time.